As serious as the impact is of inflation and taxes on true profitability, when the two are combined, their effect is substantial. The impact of inflation and taxes on profitability is unavoidable, even though it is not always taken into consideration. Yet this reality is overlooked in a majority of studies, whether they are aimed at long-term financial results or the shorter-term investment returns and cash flow within a single business cycle. As a result, projections lacking consideration of the tax and inflation impact are unrealistic. Why do taxes and inflation have to be considered together? The argument could be made that as long as comparisons are made on a like-kind basis, the interaction of taxes and inflation does not matter. In other words, if the inflation and tax factors are excluded in each case, the comparison is still valid. It is not always so, however, for several reasons. Taxes vary by the state in which the majority of business activity takes place. So, if two companies under review are active in different jurisdictions, the tax impacts will be quite different. Federal taxes change based on the dollar levels of taxable profits. As a result, comparisons between companies with dissimilar net profits are invalidated if the tax impact is excluded. Taxes become very important when projecting future growth in profitability. Under a current level of profits, taxes might be insignificant. However, if the assumptions about future growth are correct, then the resulting changes in effective tax rates could make optimistic forecasts of revenues and profits increasingly unrealistic. Inflation does not impact every organization in the same way. A study of the elements making up the Consumer Price Index showed that the collective number is the weighted average of many different products in many different areas. Different companies are going to be subject to varying net inflation rates. For example, a company that relies on the transportation of goods will be more impacted by higher oil and gas inflation than one providing a service sold over the internet. Although general assumptions and estimates of the inflation can be applied universally, the specific sector has to be considered to determine how much weight to give to inflation. Assuming that two or more organizations are going to suffer identical inflation is valid only if they are active in the same primary sector. When you calculate net return based on adjustments for inflation and taxes, the result makes more sense. A detailed analysis has to be made to adjust for varying tax rates by location and income levels, and the assumptions about inflation have to take specific factors into account. Thus, a published annual consumer price index may be weighted higher or lower based on how the elements of CPI are calculated. You need to know your net break-even return to determine whether profits are really profitable. If in fact you are losing net purchasing power after inflation and taxes, then you face a problem. The calculation of break-even return is based on the combined effects of inflation and taxes. Here is the formula. Inflation rate is divided by 1 minus combined federal and state tax rate. Here is the example. Your company invests temporarily available cash in a carefully selected portfolio of money market funds and high dividend stocks. The portfolio return has averaged 4.5% over the past year, a return that management considers positive. But is it above break-even? Based on an assumed 3% annual inflation and combined federal and state tax at 43.84%, calculate the break-even return. Let's see this example on a spreadsheet. Here is the example. The inflation rate 3%, effective tax rate 43.84%. And here is the formula for break-even return. We have the inflation rate divided by 1 minus the effective tax rate. In this case, 5.3%. Given these assumptions, your company needs to earn 5.3% on the portfolio just to break even. If you earn anything less than this rate, you are losing money on a net of inflation and net of tax basis. If you duplicate the 5.3% rate, you are simply holding purchasing power at current levels. So reacting to the 4.5% average return as if it were a profit is not realistic. The three effects of inflation and taxes make the point that a simple statement of return without these negative impacts does not tell the story. The higher the combined federal and state tax rate is, and the higher the rate of inflation is, the more you need to earn, whether from investments or business activity, to maintain asset value and purchasing power. This raises another important and troubling issue. Does the inflation task risk mean you have to take greater risks to avoid losing purchasing power? Whenever your net return falls below the break-even rate, you need to make some difficult decisions. Are the assumptions about inflation realistic? If you are applying an average consumer price index, does that include elements that do not directly impact your operation? If so, a more detailed study may reveal that a lower rate applies. Does it make sense to pursue higher profits? If your current effective tax rate is minimally above the break-even rate, what happens if higher profits translate to a higher rate? If the improvement in net profits results in a lower net return that is under the break-even rate, does it even make sense to pursue those higher profits? Avoiding greater profits due to taxes is counter to the basic capitalistic model of commerce, but you cannot ignore facts. Can the situation be improved by shifting domicile and markets? For example, if your company pays taxes in New York, New Jersey, or California, can you take steps to reduce the state tax burden? Can you relocate to Texas, Washington, South Dakota, or Nevada? The question is more complex than simply changing headquarters. The state where revenues are generated is normally where you pay taxes. Consequently, simply moving your offices to a no corporate tax state does not necessarily solve the problem. The issue of pursuing a different geographic customer is more complex and difficult, but it should be considered in the mix of possible solutions. Is it possible to increase your rate of return, whether on short-term investments or on long-term business activity? In the weak economy of 2008 and 2009, many publicly listed companies were able to improve net profits even when revenues were lower than those of the previous year. They did so by cutting expenses, which in most situations meant cutting jobs. This is not a good idea if you also want to grow. However, applying austerity to the income statement may be aimed at achieving a higher net profit, net of taxes and inflation, without cutting off expansion. Invariably, methods are available to reduce expenses, but only to a degree. The issue always comes down eventually to a decision about appropriate risk levels and margins of profit. Can the margin of profit be improved? This is a difficult task and requires taking more risks in the marketplace. How can your competitive stance be improved without exposing your employees, stockholders, and vendors to heightened market risk? The margin of profit can be improved through greater efficiencies in your supply chain, mergers with competitors, or taking greater market risks. Your company has to confront these issues when it finds the current level of net return to be lower than the break-even return rate.